Bank runs aren't something that we think about happening in this day and age. It feels like something we'd see in a black and white film.
A bank is supposed to be one of the most secure places that you can work with, right? This is not some big bet.
We were panicking. I think a lot of us were panicking.
The abrupt closure of Silicon Valley Bank really caused an immediate concern across the startup world, and was causing day-to-day concerns in terms of how these companies could operate their businesses and cause mass chaos.
Fears about Silicon Valley Bank led to mass withdrawals, mostly by businesses in California. And we're talking tens of billions of dollars worth of withdrawals from the bank.
As we know, SVP caters to the startup, venture capital community. It's a very niche kind of bank.
I think it's really important to recognize how important SVB is in the tech ecosystem globally, particularly in the US and in the UK. These companies are also the lifeblood of the innovation ecosystem.
Silicon Valley Bank was the gold standard in terms of startups and technology companies and venture capitalists.
It was quite nerve-wracking because, all our money is primarily banked here. And being one of the largest banks in Silicon Valley, 15th largest in the US overall, I think nobody had thought that it should happen.
When the bank collapsed at first, it caused a lot of immediate impacts with companies that said, whether they used the bank or not, that it was causing issues to how they could do day-to-day operations, including even making payroll for their customers.
And as soon as we heard about it, we actually got an email from our payroll company saying that our payroll deposit wouldn't be processed because the payroll company runs their deposits through SVB, which was unexpected. So then it was a matter of telling my employees, well, listen, the payroll won't go through as expected, which as a small business, one of your main things that you want to do is pay your employees on time. Luckily, it seems like that will be resolved, but then it was a question of do I wait and see and trust that these things will be handled in the proper way?
So the main problem that caused their demise was that they invested their assets in these long-term security bonds, right?
As the tech sector grew over the last 5 years, the bank's customers kept piling cash into their savings accounts. The bank then invested this money into long-term US securities and mortgage-backed securities.
It didn't have a lot of loan demand to loan that money out. So it did what you think would be a smart and low-risk thing, which is it went out and bought tons of treasury securities.
And while these investments initially looked good, they became less valuable as interest rates rose over the past year.
Now, if they were able to hold these bonds to maturity, there would be no issue.
Even if they are safe, if they are kept until maturity, until for maybe 5 or 10 years, if you sell them earlier, you might lose money.
And with the increase in interest rates, the value of those bonds went down.
So that's just a relationship we have. Yields go up, prices go down.
And that tech community, largely tech community, has had some problems of late.
The events of the last year with the revival of inflation post-pandemic, as well as this shift towards monetary tightening, has removed this safety blanket of cheap money.
Experts say that a lot of these issues are amplified because there's already concerns posed to the startup ecosystem based on rising federal interest rates and other issues with the economy, causing more hardships for them than they had faced in the past decade or so.
So that money sitting in that bank account became, instead of just money sitting on the side, became money that these startups actually needed.
Most of that money was uninsured, as you know, so above the $250,000 limit. So folks had an incentive to run. And then they decided to run because it turned out that the Fed dramatically raised interest rates.
They had depositors withdrawing cash and they had to sell some of that portfolio at a loss.
It became a crisis that the Federal Reserve and the FDIC and California regulators had to step in and do something in the middle of the workday.
In the days that followed, the government took quick action to ensure uninsured depositors and protect all the deposits in the bank so that a lot of those immediate concerns were mitigated.
The US government said they would backstop all deposits. That's insured deposits and uninsured deposits.
Look, the bottom line is this. Americans can rest assured that our banking system is safe. Your deposits are safe.
And then also the Federal Reserve opened an emergency window to allow banks to basically pledge any of these bonds that were now in question as collateral. So they could give these bonds to the Federal Reserve and then take the cash and then give that cash back to their depositors.
After Silicon Valley Bank closed, already one other bank, Signature Bank, closed, and the government had to step in to take similar action.
Well, we felt that there was a serious risk of contagion that could have brought down and triggered runs on many banks, and that's something, given that our judgment is that the banking system overall is safe and sound, depositors should have confidence.
But the collapse is still posing broader concerns for the entire startup ecosystem. Experts say that this could cause banks in the future to be more wary of taking startup customers on as clients if they're concerned that they'll have to take out their money at any time and cause a situation like this to happen again. Another issue that the tech world is facing is what seems to be a lack of empathy from the public or from people that are concerned that this is going to create another bailout, as was seen in 2008 with the big banks.
There was a huge loss of trust within the financial sector around the 2008 financial crisis, and that's taken a long time to rebuild.
An expert that I spoke to talked about how this sort of created in 2008 a Main Street versus Wall Street narrative, which is likely to play out here as well. In Washington, this is also playing out with a lot of finger pointing. Democrats are blaming the former Trump administration and congressional Republicans for rolling back bank regulations that they said would have helped protect a situation like this playing out.
We're reaping the consequences of lighter regulation. When Chair Powell started leading the deregulatory movement in the Federal Reserve and getting the regulators to lighten up, the consequence is problems get missed. Banking should be boring.
Whereas Republicans are playing this up as a partisan issue and accusing it of being a woke bank and not causing the issues that were played out with Silicon Valley Bank.
Banks in Oklahoma, in rural towns, are about to pay a special fee to be able to bail out millionaires in San Francisco.
Experts that I spoke to said that this isn't the same as the bailouts that we saw in 2008, even though advocacy groups are already criticizing action that's been taken and warning the government against taking further action to protect the bank. The government so far has protected the depositors and ensured their deposits are safe versus bailing out the banks and the shareholders themselves.
Investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
Concerns about how this might impact the startup ecosystem and limit banks from being able to take on these clients or being more cautious of it is also spurring concerns that it could stymie innovation and lead to startups innovating less aggressively as they had been in the past decade or so. In addition to the concerns that this is causing about the startup ecosystem, the closing of Silicon Valley Bank also brought up concerns that this might have broader implications across other banking systems, but President Biden and other lawmakers have sought to assure the public that that won't be the case.